Despite all the negative news in the media warning us that the worst property correction on record is ahead of us, my guest today, Pete Wargent, recently wrote a piece giving good reasons why our housing market downturn could be short-lived. Now, Pete's a realist. No one would call him a property bull, so I'm looking forward to discussing his thoughts in this month's Big Picture podcast. Since Australia's economy and our property markets don't operate in isolation, each month I take time out to have a look at the big picture, the macroeconomic factors affecting not just Australia, but the world economy in these Big Picture podcasts with Pete. And it's our attempt to give you a bit more clarity on what's ahead. So once again, today we take a deep dive into what's happening in the world and Australia's economy and our property market. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Boy, has there been a lot happening since I last spoke with Pete Wargent for our monthly Big Picture podcast. Now, as we sit here today, inflation is the highest it's been for years, and it's only going to get higher. Interest rates rose again this month, and people are wondering how high are they going to go. Bitcoin has crashed and plenty of stocks are down. The war in Ukraine continues. Supply chains are broken. The pandemic's lingering. China's still in the form of lockdown. We've got a new government. It goes on. And according to the big banks, we must brace ourselves for the worst housing correction on record, as rising interest rates and recession fears, according to some commentators, are going to strangle the property market. Now, while regular listeners will know Pete well, if you're new to this podcast, well, firstly, welcome, because I can see we're getting thousands of new listeners every month. But the reason I'm keen to discuss these matters with Pete is not because of his academic credentials as a chartered accountant, a chartered secretary, or because he's got a financial planning diploma, but because I enjoy these chats with Pete because of his credible perspective that he brings about what's happening to the world, as he's an international investor as well as a business person. So after that long-winded introduction, welcome back again, Pete.
G'day, Michael, and hello, listeners as well.
Now, Pete, I want to ask your thoughts about how long this property downturn is going to last and how deep it's going to be. But before we do, I'd actually like to go up a level and look at the macro factors. Now, I spoke about some of the challenges we're experiencing, but Pete, we shouldn't forget how well our economy is actually doing.
Well, no, and I guess this is ultimately what has driven inflation and interest rates to be normalised, is that the economy has been growing and it's rebounded very quickly. So particularly in what they call nominal terms. So GDP growth over the year to March was over 3%, but if you actually look at nominal GDP, which is the growth in the economy in current prices terms, very, very strong. So Australia's exports are at record highs, coal and LNG and iron ore. The economy's come roaring back. So in many ways, the fundamentals for the economy and for the housing market, they're the strongest we've seen in many respects since the mining boom. I guess the flip side is now everyone's worried about inflation and rising interest rates, but I guess there's always something to worry about.
Isn't there? And if we don't have anything to worry about, the media will soon give us something to worry about. So Australia as a country, its economy is doing well, but back home also, we're spending more. Retail spending has lifted one month after the other, and the figures have just recently come in for May showing credit card purchases were $2.76 billion in the month of May, according to the Reserve Bank, up 12.5%. So one of the things that I can see happening is that we're being let loose. We've been given a couple of difficult years and we've stashed our cash. We know that some suggestions are that there's been, I don't know, close to $230 billion worth of stashed cash savings. And I think people are spending it, and retail spending is going gangbusters, despite the Reserve Bank trying to slow us down, Pete.
It's interesting when you look at those retail figures. If you remember pre-pandemic, every month the figures had come out and they'd be up 0.3% and 0.2%. I think the interesting thing, well, you mentioned there was the stimulus, and also people haven't been able to travel internationally so much. So retail turnover now is running at about 35 billion a month. It's absolutely miles above where it used to be, probably about a quarter higher than we saw pre-pandemic. So some of that turnover has shifted to online retail, but yeah, there's lots of consumer spending in the economy, and that's, I guess, alongside the government stimulus, those have been the two key drivers of the recovery. People have had so much cash to spend, haven't been able to travel overseas, and it's just getting poured into consumer spending.
And of course, domestic tourism is increasing, so we are getting a few people from overseas. But just try and travel anywhere in Australia, and it's hard. We know what happened during the recent school holidays. You couldn't get on a plane, and wherever you ended up, the accommodation was taken as well. So that's all looking good. So in simple facts, we're in the box seat to keep growing well economically moving forward, even though the Reserve Bank wants to slow things down a bit.
Yes, and if you look at employment in Australia, that's at record highs. Unemployment rate near enough the lowest in 50 years. I think the interesting thing is that the economy is just creating so many jobs. There's nearly 500,000 job vacancies now, 480,000. We've never seen a number like that before. And I suppose, when you look at it, there's not that many more unemployed people than job vacancies. The ratio is about 1.1. So it's literally never been easier, in a sense, to find work. I think this does have a knock-on implication for the housing market, because the Labour Party Treasurer, Jim Chalmers, they're now just making noises about easing migration caps to fill those job vacancies. So we've had a couple of years with not very much in terms of population growth, but now it's going to come roaring back to fill all of those skill shortages that have been created.
Well, it's got another effect on the housing market as well, because we know inflation's high, we know interest rates are going to go up, and some people are going to find it a bit hard to pay their mortgages, Pete. But if there was unemployment, then I would be concerned about those first two factors. But anyone who wants a job's got a job, and as you correctly said, almost everybody who looking for a job, there's a job for them, which basically means that people aren't going to stop paying their mortgages. So the concerns people have got at the moment about our property markets are basically related to the interest rate rises. And you and I have read the same things, 10, 15, 20%. And there's one prominent commentator in the Financial Review who's even suggested that if interest rates go up as much as he's predicting, the property market may drop 30%. But in my mind, interest rates are just one factor. Our economy is growing. It's not collapsing. We're in a buyer's market. In the next 6 months, I think there's actually going to be a strategic opportunity, window of opportunity for people to look into getting into property, because this too shall pass. And by the time the media actually tells us that we're over this hump or slump, the market will have moved on. But maybe we could just have a look at some of the negative factors and then some of the positive factors. On the negative side, we've said rising interest rates, cost of living pressures. And yes, rising interest rates are going to reduce our borrowing capacity. And there's no doubt that the rise in values and now of property values are causing affordability issues, because wages haven't gone up anywhere like what property values have gone up. And yes, there's uncertainty about our economic future. Pete, I think that's one of the biggest factors, consumer confidence. And we've seen that in the past in previous cycles, because if people are confident, overconfident, you get the fear of missing out like we had a year or two ago. But if people are nervous and negative, it can end up being a bit of a self-fulfilling prophecy of the market slowing down too much.
I would go a step further. I'd say it is the only negative factor at the moment. Yes, it's inflation, rising interest rates and sentiment, but it's really just one thing. People are worried about, we haven't seen inflation for maybe, 13 years or something. It's not something a lot of people are familiar with. Lots of media talk about rising interest rates, and that's just hammered sentiment. But I suppose the interesting dynamic at the moment is that the underlying fundamentals for the housing market, they're probably the strongest we've seen since the mining boom years. Wages for a lot of employees are now rising. Skill shortages creating pay rises. We mentioned job vacancies and employment, record highs. Unemployment at 50-year lows. But I think if you look at the supply and demand in the housing market, Well, rental vacancies, they're the lowest in 16 years. So rents are rocketing higher. And I think that's because the number of persons per household has declined over the past couple of years. Then you've
Well,
got
the census showed that, didn't it, Pete? That despite the tourists not coming, despite the migrants not coming, we actually didn't like living with other people as much as we used to. So we actually, this last census showed that rather than 2.6 people per household, it's dropped to 2.5. That doesn't sound like much, but it actually needs an extra 200,000 dwellings to accommodate those people.
Yeah, and there might be some reversal, I think, as things go back to normal. But I suppose just anecdotally, I met some friends in Brisbane CBD. They're from Iran originally, so they're kind of used to higher density living. And I think they live on level 60 or 62 on one of the towers on Queen Street. They couldn't use the lift through COVID because of the restrictions. So you can see why things like share houses and those high-rise towers, they've not been a great place to be for 2 years. And that sort of moved a lot of the demand out of those CBD areas and into the suburbs and created all that extra demand for housing. And that's at a time when construction costs have gone through the roof. So there's no supply coming either. So you put all of those factors together, the fundamentals for the housing market as immigration starts to go back towards, say, 400,000 per annum, all very strong. There's just one thing that's missing, and that's sentiment. And that's all driven by the fear of rising interest rates.
Yes, it is. Now, I guess that's what the Reserve Bank wants. It wants us to stop spending and slow down inflation. You mentioned about the lack of new dwellings because of construction costs. What we're hearing is that there's a lot of what used to be called shovel-ready developments. They were ready to go, but they just don't make financial sense at the moment. They can't get pre-commitments. They're not sure if a builder is going to even be able to complete the job because builders are going broke and banks are worried about lending for those. So there aren't as many new developments, even though approvals are increasing a bit in the system. There just isn't enough new stock coming onto the market. And all those migrants coming from overseas don't bring a home with them, do they?
No, and I think it's much harder to get those developments off the ground now because there are stamp duty surcharges for non-resident investors. So who's going to buy those new units to get the developments built, especially at a time, as you said, when there's a shortage of materials, shortage of labour, construction costs are up by maybe 20 to 30% from where they were. So there's a lot of factors making it very difficult for new supply in the unit and apartment and townhouse market at the moment. I think the other thing on the supply and demand equation, a lot of talk about the housing downturn, but actually there's been no rush for the exits. And in fact, stock levels keep tightening. I think down again in June, I think about 26% or so below the half-decade average. So it's not like there's a whole load of stuff being listed on the market either, and stock remains pretty tight overall.
Sure. In other words, the supply and demand ratio is one of the factors that I guess makes both of us believe we're not going to have a housing market crash. So just to make it clear, there are two sorts of sellers: people who are discretionary, they got a choice, and I guess there's non-discretionary, and there's currently very few mortgagee sales or stressed sales. I'd like to discuss that with you in a sec, but people still sometimes have to sell because they get divorced or because of death or because they have babies. But a lot of the discretionary sellers, Pete, why would they put their house on the market? I mean, it's happening particularly at the higher end. That's the area where property values have dropped a bit. Look, maybe you don't need a $20 million trophy home in Toorak or Brighton or Rose Bay if your $15 million trophy home's good enough.
The number one indicator of mortgage stress, there's a lot of talk about these indicators of stress, but really it's whether or not you have a job. You know, that's the overwhelmingly the number one factor. And as we mentioned, there is a job now for everybody who wants one, and pay rises and bonuses at the moment. So there's not going to be many forced sellers in the market. So at the top end of the market, yes, you generally find in the premium sector of the market, it's quite a thin or a liquid part of the market. There's far fewer buyers typically, and it can act a bit more like a stock market. It booms on the way up and it crashes on the way down. And I think actually, you know, there's some of those sort of 3 million plus markets, you've probably seen prices off 10 or 15% just because there aren't the same number of bidders at the auctions now. You might have had 50 people at the open home late last year and now maybe 5, you know. So there's certainly some prices coming off at the top end of the market, but I'm not seeing it anywhere near as much in the median or lower prices. Certainly not at this stage anyway.
Now, again, we're not suggesting the market's not going to slow down. I'm not, and I don't think you are either. And we've been around before, and it could well in many areas drop 10%, but there isn't a Melbourne property market. So the upper end is slumping at the moment, and it could well be that some of the new home packages in the outer suburbs aren't going to sell as quickly, but they've all been pre-committed. There's not a lot of developers doing speculative work at the moment in apartments or in houses to actually make that end of the market drop. But Pete, you were saying a minute ago about mortgage stress. So some people say mortgage stress is when you're spending more than 30% of your income on your mortgage. The bottom line is that some people have to spend more than that to get in the market, but that doesn't mean they're financially stressed and they'd rather eat Maggi noodles and they won't go out as much and they won't take a vacation to keep their mortgage. But recently, there's one of the regular commentators who tells about how many distressed sales are on the market. So I was interested to see that he said the number of distressed sales have just recently gone up. But how does he know? And what I found out was, and he said it clearly, he's actually looking at what the agents are advertising in the words that are used. And there's only a couple that are mortgagee sales or bank sales. The other is words like price reduction or urgent sale or for quick sale. That doesn't mean it's distressed, Pete.
No, it's a funny thing. Years ago, we used to say, well, 3% vacancy rate was a kind of a balanced market. And if you spend over 30% of your income on a mortgage, you're in mortgage stress. But if you think about it, it is actually rubbish. It's not like, let's say I've just bought my first home with Heather and we're spending 29% of our income on the mortgage. And then there's an interest rate hike and it goes up to 31. It just doesn't change your life because you're going across some arbitrary number. What it might mean is you cut back on a Netflix subscription or probably Sky Sports back in the day. But it might have an impact on consumer spending in the economy, which after all is the idea. But it doesn't mean you're going from 29 to 31% is suddenly stressed. Much more important is, can you find a job and reliable income, which at the moment, yes, you can.
Of course, the headlines are telling us we had a triple whammy with the Reserve Bank giving 3 interest rate rises in 3 months. But Pete, in my mind, interest rates are still too low. They're at stimulatory levels. And look, the Reserve Bank governor knows much more than me, but I would have been pushing them up to more neutral levels quicker because otherwise they've just got to keep increasing it over the next little while to at least get to neutral, which I guess won't happen until the end of the year.
Yeah, so you mentioned a key phrase there earlier, and that is window of opportunity. I think the market will turn round at the point at which consumers no longer fear rising interest rates. So if you listen to the people in the know, like Bill Evans at Westpac, they're talking about a terminal cash rate for this cycle, the highest point it will reach of about 2.5%. And in fact, the consensus across all of the quoted economists is about 2.5. So that means you've got between now and the end of the year, you're going to see interest rates going up, probably to maybe 2.4, 2.6, somewhere around there. The inflation figures are likely to peak in Australia in the fourth quarter of the year because there are still things like power bills, electricity costs, and rising rents to go through. And those figures will get reported in February. But I think from that point on, I mean, I'll whisper it quietly, but financial markets are looking for interest rates to fall next year. So it's not like we're heading for a period of very high interest rates. It's just that they're rising. And I think that's a lot of borrowers have never seen a rate hike before. So it's just spooking a few people.
The other thing that's spooking them is the word recession that keeps coming up a little bit. And economists are suggesting the odds of a US recession in the next year are now roughly 1 in 3. In the past, they used to say when the United States sneezed, Australia would catch a cold. Are you concerned about what's happening in the world economy and recessions?
Oh, look, I think if you look at what, some of the traditional indicators of recession are, without getting too technical, what they call an inverted yield curve. And yes, we've seen a couple of times that indicator flashing red. So there's every possibility that you get 2 quarters of negative growth, or the NBER has a slightly different definition in the US. So it's entirely possible. But again, it's a bit like the arbitrary definition of mortgage stress. Just because the economy's flat for a couple of quarters doesn't mean it's the end of the world. I think in Australia, well, as we said, in the last quarter, nominal GDP rose 3.7% in the quarter. So I don't think we need to worry too much about the economy slowing too much at this point. I think actually it probably needs to be dragged back a little bit because a number of factors have been absolutely booming. So technical recessions are always possible, but Australia tends to, with its strong immigration program and so on, we very rarely experience negative growth. It just happened for the first time in 30 years through the pandemic.
Now, I enjoy reading your daily blogs that people can get at petewargent.blogspot.com. And you recently said that you believe the housing market downturn that we're currently experiencing, by the way, I'll leave a link to your blog in the show notes, but you said that the housing market downturn could be short-lived. Why do you think that?
Well, I think the key factor that we've already touched on is sentiment. The fundamentals for the housing market are very strong. Supply and demand, there's a huge amount of demand coming as immigration ramps up again. So the key factor is really inflation expectations. Now, in the US, inflation expectations over the next 5 years have already fallen dramatically, all the way back towards the target. If you're looking for indicators in Australia, well, Australia's 10-year bond yield, at one stage it was above 4%. That's already dropped off very rapidly. Same with the 3-year. Inflation expectations are dropping. I think it's one of those things. There's a period when inflation is rising quickly. The dynamic is you try to buy stuff before the price goes up. But I think that dynamic is now shifting. I think a lot of people are like, well, I don't want to fill up the fuel in the tank at the moment because the price is going to come down. It's the same with second-hand goods and furniture and things. You can see that prices are going to come off. So the inflation dynamic has really reversed. And commodity prices this year have been tanking. So I think all of that fear about rising inflation, yes, Australia is still going to report some higher numbers later in the year, but the forward-looking indicators have really cooled off. I think it'll be very interesting to see on the 1st of February next year how the housing market kicks off, because by that stage, I think the fear of rising interest rates might well have dropped away.
Well, as we know, our property markets are driven by fear and greed. And as we kept saying, therefore, it's really consumer confidence that's one of the biggest factors that affects people's big purchasing decisions, like homes, like investments, like cars. Having said that, at some time, I agree with you, greed will overtake fear as property values drop a bit, as people just have to move on with their life because they're still going to get married, they're still going to have babies, they're still going to need to change jobs, and all those factors are eventually going to, just over 2 years ago, in the early stages of COVID, people were nervous, uncertain, stopped making decisions, and then they just moved on again, didn't they?
The thing that's, I suppose, been spooking people, we haven't really seen a hiking cycle like this since, and you would remember, there's 1994. So in 94, there was inflation fears, and between August and December that year, there was, interest rates went up 2.75%, and that actually did trip a very small housing market downturn. But it's just something we haven't seen for such a long time. But I think, a lot can change in a month or two. I think you'll probably find that a lot of the rhetoric about interest rates going to 3 or higher percent, I think it will start to ease as people say that actually inflation's probably not here to stay and we'll be back towards the pre-COVID dynamic fairly soon.
Yes. So are there any risks that you can see that could get us out of the blue, strike us out of the blue, that maybe we should watch out for?
Yeah, I think the big one is just we've had these supply shocks that have really driven inflation. There was lockdown restrictions in China, the Ukraine war. I suppose that those are the big risk factors. If China goes back into deep lockdown situations or restrictions, if there's another sort of oil supply shock, those would be the big risks. If supply chains get severely disrupted again and we start seeing another bout of inflation, well, that's the biggest risk. At the moment, it seems to be that actually commodity prices are falling away again and everything looks good. Oil prices are off by 25% and a lot of analysts are seeing them falling further. But yeah, I suppose that's the risk because we got blindsided by this once before. If the Ukraine war sort of drags on and there's other supply-related issues, well, I suppose that's the main risk to look out for.
Well, one of the things I look out for looking forward is finance approvals, because they tend to be a leading indicator of what's ahead for property values. If fewer people are obtaining finance approvals at present, it suggests our property markets will be a little bit weaker moving forward. And clearly, housing loan approvals are off their recent highs, and they're likely to turn lower as the sentiment decreases and interest rates bite on loan demand. But there isn't a sharp change in this at the moment. Owner-occupier loan commitments peaked in May last year, and they're down a little bit, they're flattening, but investors are coming back into the market, and the investor share of loans has now recovered from their lows during the pandemic stage. I guess the other interesting thing I've noticed, not surprisingly, is the share of fixed rate loans has plummeted. People sort of realise that the gap between what they can pay for a variable loan and a fixed rate loan is maybe a little bit too high at the moment.
Yeah, well, I think you summarised the whole dynamic perfectly. I think the interesting thing is, pre-COVID, housing finance was running at about 20 billion a month if you exclude all the refinancing. Last month, everyone was sort of expecting a softer number. It was 32 billion, so it might have come back a bit off the highs, but it's still very high. And I think this kind of belies some of the media commentary. Actually, there's a lot of borrowing there. And it seems to be that, yes, as you said, home buyers have just cooled off a little bit. I think in Sydney and Melbourne in particular, home buyers are just circling rather than looking to buy soon. But investors in particular have been coming back into the market very strongly. I suspect that's for two reasons. Firstly, seeking a hedge against inflation, because if inflation gets to 7%, who really wants to be sitting in cash? And I think the other thing is that rents are rising very strongly, not everywhere, but certainly for houses. And in some cities, there's a real rental crisis around the country. So there's a couple of things that are actually bringing investors back. You wouldn't really know this reading the media commentary about the housing market, but 32 billion of finance in a month, that's not a soft number.
No. Now, interestingly, one of your other blogs on petewargent.blogspot.com was pointing out that interest payments are the lowest since 1994. So a lot of people are talking about how indebted we are. They don't always talk about the other side of the ledger, about how much assets those debts are against. But it was an interesting point that you'd made out, and I love the charts that you put in your daily blogs, is household debt to disposable income isn't really that bad at the moment.
No, so I guess the number that gets the most amount of clicks is the sort of household debt to disposable income ratio. There's about 1.8 to 1.9 times, and that's pretty high globally. But I suppose one of the things that's somewhat unusual about Australia is the massive use of offset accounts. So on a gross basis, there's a lot of debt, but then people have got billions and billions socked away in offsets. So the amount of interest that we're paying is, as a ratio of our income, is actually the lowest, as you said, since 1994. That's partly because people don't use credit cards as much now. I think a lot of people have cleared their credit card debt through the pandemic as well. So, you're right. I think we've probably seen the bottom for the cycle, and as mortgage rates go up, interest payments will sort of rise as a share of income. But if you look compared to where they were in 2006, we're at about half. So it's an enormous decline in the interest burden since that time. And yes, they'll normalize a bit, but we're way, way below the 40-year average at this point.
So I guess part of the message we're saying to people is be cautious. There's no right time to buy a property. I guess it was 20 years ago. And the second best time is when you're ready financially. So my suggestion is to make your investment decisions based on your finances and your long-term plans, and not based on market timing. But there's another interesting leading indicator that I read a couple of days ago that probably worthwhile finishing this chat with. And there are signs emerging that Aussie consumers are now preferring to spend their money on other things than cars and homes. Now, we spoke a while ago in previous podcasts about how luxury cars were selling very quickly, but we know the top end of the housing market's slipping. But a recent CommSec report showed that luxury new car sales are slowing down as well. And this is interesting, Pete, because it's insightful. In the past, it's been notable that the top end of the housing market and the top end of car markets, the luxury car market, have both led movements in the broader market. It looks the same is occurring now. So interestingly, the ComSec index of luxury car sales has fallen to a 19-month low. So people aren't buying their Maseratis and their Bentleys and the high-end Mercedes now. And I guess much the same is happening in the Sydney and Melbourne housing high-end market is dropping. So I don't know really how much we can read into that, but maybe people are just being a bit cautious in both those luxury ends of the market.
Yeah, it makes perfect sense. I think people are just sitting back on the sidelines, just waiting to see how things play out over the next 6 months. I think what we'll probably find is that interest rates peak at a lower level than feared, and then people will wake up sometime in the early new year, maybe after Australia Day weekend, and realise actually, a cash rate of 2.5%, it's just not that high. I think there's a lot of people just...
Well, it'll be back to where it was pre-pandemic,
pretty
Pete.
much, yeah. I think just before the pandemic, we were getting down pretty low. But yes, you're right. I mean, in historic terms, it's still a very low cash rate. And, it was only sort of 7 or 8 or 9 months ago that people were worried about inflation being too low. And, the target was too low. And it's only really just through the supply shocks that we've suddenly seen this rip of inflation. But, we'll have to see what plays out, but it's certainly the recent dynamics. Bond yields have been falling, commodity prices falling, inflation expectations have dropped very quickly. So it seems like the world isn't going to end, and I think at some point people will wake up and realise that. Unfortunately, they'll try and buy into the housing market just as it gets busy again, but you can't change it. That's the way it always is.
That's the way it is. So again, take a long-term view and don't make 30-year investment decisions on the last 30 minutes or even the last 30 days of news. Now, Pete, I've mentioned a couple of times about your blog. I also love your podcast, and anyone who's listening to this obviously likes podcasts. So I know you have great guests on your podcast. I listen to it. I look forward to listening to it as I take my dog Lincoln for a walk once a week. So where can people find out more about both of those?
Yes, you mentioned my blog, Pete Wargent Blogspot, just a daily insight, and also podcast is the Pete Wargent Property Pod, which you can find on Spotify or Apple Podcasts or wherever else you get.
Well, wherever you're listening to this, because if you're listening to this as a podcast, Pete will be just around the corner as well, and I will leave a link in the show notes as well, Pete. So thank you very much, and I look forward to catching up with you again in a month.
Pleasure. Thanks, Michael.
In a moment, I'm going to share my popular mindset message with you. But just following on with my discussion with Pete, I hope I helped answer some of the common questions that you've got in your mind. I mean, the common questions people are asking us at the moment is, what's ahead for our property market? Should I buy? Should I sell? Should I sit on the sidelines? I guess they're wondering about inflation, interest rates, the uncertainty, whether there's going to be a crash. So hopefully we've given you a little bit more clarity. But if you're unsure what the current market means for you, for your property investment or your home buying plans, and what it may mean for your existing property portfolio if you've already got one, why not have an obligation-free chat with one of the property strategists at Metropole? Remember, we have no properties for sale, which means that our advice is holistic. Remember, we have been helping clients for over 20 years. In fact, the property strategists are delivering the frameworks, the strategies that I've fine-tuned for close to 5 decades. So go to metropole.com.au and get some independent, unbiased advice. We offer you a time-tested system. We have a proven track record of being involved in over $4.5 billion worth of property transactions. And if you do eventually want to buy a property, we've got our true on-the-ground teams in Melbourne, Sydney and Brisbane. You can trust Metropole to help you outperform the average and give your family the financial freedom you deserve. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to talk to you a bit about worries. In fact, the evolution of worrying and how in the past it may have been protective, but why today it may not be as useful as that. Think about it. Thousands of years ago, it was part of what kept humans alive. Is that a lion in the bush? Was it that tiger? 9 out of 10 times, there probably was no large saber-toothed animal out there to pounce, but worrying saved lives. Often this then became ingrained. But fast forward to the present day. You're probably listening to this on your smartphone, and you probably don't have to worry about things that our ancestors did. But I bet that doesn't stop you from worrying, does it? Today, instead of being hyper-vigilant about big scary predators that could actually kill us, we obsess about the economy, the property markets, our job security, the value of our homes, or other sources of possible inconvenience. But there are 2 problems with this. Firstly, most of the things we worry about just don't happen. And secondly, even if they do happen, worrying doesn't really help, does it? Today, rather than keep us alive, our worries are more like spinning on a wheel in a ditch. They tend to be pointless, ineffective, and often border, for some people at least, on compulsive and neurotic. So my recommendation to you today is to get out of your worry rut. But this takes practice and this takes determination. So next time you feel stuck in a rut of worries, try asking yourself these simple questions. Firstly, ask yourself, what's the worst thing that can happen? If death, dismemberment, or complete financial collapse is actually occurring to you right now, well, okay, you're allowed to keep worrying. If not, just get back to work. The second question to ask yourself is, when I worried about this in the past, did it actually help? If you think about it, worrying about things almost never helps. If it isn't helping, then why worry? Why keep doing it? And the third question to ask yourself is this a now problem or a then problem? How often have you created a problem of mythical proportions? Oh, look, I've lost my iPhone. Somebody's stolen it. I'm going to become a victim of identity theft. Only to discover that in reality it wasn't a problem at all. Oh, look, there it is. It's left inside my car. So don't confuse then with now. Think of all the mental energy we can free up for our family, for creative pursuits, for even earning a bit more money on the side if we stop worrying incessantly, if we stop worrying unnecessarily. Now, I'm not saying never worry. I'm just gently suggesting not to get stuck in the rut of continuously worrying. Try and keep your worrying in a healthy groove instead. Thanks for spending the last 35 minutes with us. I hope Pete and I have helped allay some of your fears and give you a bit of clarity about what's ahead. And if you did get some benefit from this and you know somebody else who would also benefit, please send them details about the Michael Yardney podcast. Tell them about it or use the share button on every podcast app or whichever way you like, because I'd like to make as many people as possible financially independent. Now, I'll be back again real soon. You can catch me in between these shows on social media. Just look for Michael Yardney or join my private Facebook group. Go to Property Updates Facebook group. And I've also got a bonus for you as a way of saying thank you for subscribing to this podcast. Go to podcastbonus.com.au where I've got a heap of ebooks and reports. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?